Tom Lee's ETF, the GRNY Shot ETF, ticker symbol GRNY, is breaking the records in less than 9 months since the launch on November 7th, 2024. It has surpassed $2 billion in asset under management, making it the fastest ETF in decades to hit this milestone. The surge in the inflow is driven by Tom Lee's strong reputation among both retail investors and institutional investors. Many of the retail traders get to know Tom Lee by watching his appearance on CNBC, and Tom Lee has been mostly right in his stock market predictions in the past. And institutional investors follow him through Fundstrat. He has a lot of institutional investor clients in his company, where it's a research firm, and Tom Lee provides market strategies for those investors. On top of that, GRNY ETF has delivered a strong performance since the inception. So year to date, in 2025, GRNY is up 17.8%, significantly outperforming NASDAQ 100, which is up 10.6%, and S&P 500 is up 7.9%. So GRNY has clearly outpaced both major indices by a wide margin so far this year. Tom Lee's current momentum with GRNY ETF reminds me of Cathie Wood from a couple years ago. She had a lot of followers, and she had an ETF called ARK Innovation ETF, ticker symbol ARKK. It was a standout in 2020. The price soared nearly 240% when the Federal Reserve was pumping unprecedented amount of money through QE into the financial system as a response to COVID-19. So when the QE stopped, the fund faced a sharp reversal starting in early 2021, and at one point it was down 80% from its highest point. On the other hand, GRNY Shot ETF GRNY started during a hawkish Federal Reserve period where Fed was performing QT, right? November last year was still doing QT. Even today, it's still doing QT. So QT is considered hawkish, okay? And the interest rate was at a decade high as a result of course, inflation control. In my view, the GRNY is likely to be more successful in the long run than ARKK. The two ETFs have fundamentally different investment philosophies. ARKK focuses solely on innovation, often holds unprofitable or early stage or small cap companies. Well, for example, on the top holdings, we have Roblox and Shopify. Those two, even though they're no longer small caps, but they are still unprofitable. So ARKK's strategy prioritizes on disruptive technology, disruptive potential over financial stability or profitability. In contrast, GRNY targets profitable U.S. large cap companies, making it inherently more stable. This makes GRNY potentially less volatile compared to ARKK. Although both ETFs are actively managed ETFs, GRNY stands out for its simpler, one-dimensional strategy. It focuses solely on stock selection, about 35 profitable large-cap U.S. companies, using a equal weight strategy on the ETF, meaning that every single stock in the portfolio have the equal weighting, and this gets rebalanced every quarter. So it's a very simple stock picking, stock selection method for Tom Lee, where he can just focus on every month what stocks to be added and to be removed from his basket. And he does not need to think about how much conviction he has for each stock because the weighting is equal weight. In contrast, ARKK follows a traditional two-dimensional strategy requiring both stock selection and conviction-based weighting. Right? If she likes Tesla a lot, she'll give it 15%. Who knows, right? So when it's a two-dimensional strategy, it's a lot more complex than a one-dimensional strategy. Additionally, ARK Invest, where the company who owns the ETFs that runs by Cathie Wood, ARK Invest offers a wide range of ETFs and financial products, which dilutes Cathie Wood's focus and energy, making it very difficult for her to maintain a strong performance across all the funds. right? In contrast, Tommy only has one fund, and it's a one-dimensional strategy, so he can actually focus. If you want to learn more about how the GRNY Shot ETF selection is done through different themes and stuff, check out my video posted on July 14th. For those interested, I believe this ETF is very interesting, very compelling, and could fit into the speculative portion of your portfolio as a long-term investor. But the speculative portion of a long-term investor's portfolio can be different. Some long-term investors don't want any of it, right? They want 0%. Some is okay with 5%, some okay with 10, some is okay with 20. It all depends on your risk appetite. Overall, I don't think this ETF is extremely speculative. It's actually fairly safe compared to the average of all the speculative stocks and ETFs. But it's definitely riskier than your typical passive index fund for a few reasons, right? Number one, it's an actively managed fund. So anything actively managed will be more risky. Second, it carries a higher expense ratio of 0.75%, which is the same as Cathie Wood's ARKK. Third, there is a key person risk, meaning that since the strategy and the ETF is closely tied to Tom Lee, any decline in his performance or something happens to him, like if he departures from the company or something, could impact the ETF's result. That's all I want to share with you today. Thank you for watching. Please like and subscribe.